for public viewing. I want to recognize that all of our Finance and Audit Committee members are present. Bill Heinzen, Lorraine Cortez Vasquez, and Don Pinnock, as well as our Board of Directors Chair, Anna. We will now have a presentation of the FY23 financial audit of the Mayor's Fund. So we welcome Brent Jensen and Jonathan Gemerick from the FPR Group, our auditing firm, to walk the board through the results of our financial statements for FY23.
Okay, so first I'm going to share my screen here, get the presentation up for us, and then we'll get started. Okay, Marcella, can you see the PowerPoint here, this main page? Can everybody see it?
Yes, thank you.
Okay, and then it sounds like we lost Brent again, right, Brent? Sounds like it. Okay, all right, that's no problem. Brent's out at a different client on Long Island today. He's helping with the audit of a school district. So I knew he wasn't sure he was going to have great connection for a Zoom meeting. So we'll get started. Today, some of the things we're going to go through is the EFPR engagement team that we had on your audit, the timing of procedures. I'll go through some financial results, obviously, of the statements that are being presented. And then there's some other required communications like the report to the board and some government internal controls opinion that we were engaged to provide as well. So first is the engagement team on the 2023 audit. It was the same team we had last year. Brent was a partner on the engagement. And my name, John Gemerick. I was the engagement supervisor. We had some other additional staff members at the office help on the audit. And then mainly Brent and I were the reviewers of all the field work, took a look at every work paper. And we also, as a firm policy, have a technical review partner on every job. So Doug also took a look at the financial statements when they were presented right before draft format to make sure all of the numbers and all the proper disclosures were included on there. Timing of procedures. So we started receiving information from Jill and Peter in about the middle of summer, a little bit in July and August, and then we wrapped up a lot of the field work in September. And so summer, fall 2023. We issued draft statements on September 25th. And then we are here doing the presentation today on October 5th. So if you have a copy of the financial statements in front of you, this would be page 9, and we can follow through. I'm going to go over some of the large balances, some of the big changes from last year to this year that occurred on the finances, and we'll go through a couple of the main pages next. So the very first bullet, overall, everybody's most important, most favorite one to take a look at is we will be issuing an unmodified opinion on the financial statements. So all the numbers being presented here today were fully audited. We have reasonable assurance, and they're all well-represented, unmodified opinion numbers. So that's the best opinion you can get on the numbers, and they're set in stone. Cash at the very top of page 9 is the first item on the statement of financial position, and cash decreased from the June 30th, 22 to June 30th, 23, a little over $1 million to a balance of about $3.9 million at June 30th, 23. So again, everything on page 9 here is numbers as of June 30th, 23. So they'll all have changed probably significantly between now and then. But as a presentation of fiscal year 23, these are all your final balances on June 30th. Receivables increased about $129,000 to a balance of about $1.3 million as of June 30th, 2023. And receivables can fluctuate a lot just based on whether it's June 30th or July 1st, July 2nd, depending on the timing of receipts and when they come in, and grants when they're signed. can change that receivable number very much. That balance of about 1.3 million is made up of pretty much a lot of receivables from two different sources. About 364,000 from AmeriCorps related to the federal AmeriCorps grant and program. And then there's about 950,000 in outstanding pledges still from the Robin Hood Foundation for various different programs. Investments decreased about $422,000 from June 30th, 22 to 23 to a balance of about $10.7 million. The security held in that investments line is an intermediate duration bond fund. So that asset decreased in market value from 22 to 23 again. It's kind of a twofold asset that is affected by interest rates and affected by market value. So the market has really fluctuated over the course of fiscal year 23, and interest rates did rise. So that helped the loss be a little less than last year. But as you can see, still overall, the asset decreased about 422,000. Down in the liability section, accounts payable. Your AP decreased about 642,000. So again, that's a timing thing, just depending on the date of checks, the date of invoices, when things are paid, whether it's right before the end of June or a little after, that number can fluctuate a lot. But that $1.7 million does have one really big balance that makes it up. And there was a $675,000 outstanding invoice to the CUNY Research Foundation related to the College Now for Careers program at June 30th. So as of now, the invoice has probably been paid. That accounts payable number very well may have changed. And then down on the bottom in the equity or net position section, you can see net position decreased from 22 to 23. And you can see the unrestricted balance has turned to a deficit. A lot of that is due to the fact of the investment losses. And then we'll take a look at what makes up the overall decrease in net position on the following slide here. So the statement of activities, this is page 10 if you're following along with the statements. And you can see it's the revenue minus the expenses shows your operating loss, and then the non-operating revenue and expenses are included down at the bottom. And you can see that change in net position overall was a loss of about $887,000 in 2023. So less of a loss from 2022 when it was about 2.7 million. And a lot of that has to do with the investments. We'll go through on the next slide a few more bullets detailing out some of these numbers. So as mentioned, operating revenue towards the top of page 10 decreased about $9 million from the year 22 to the year 23. This is mainly a result of some one-time contributions for some more one-off events that happened in 22 but didn't in 23. So the Bronx fire, a lot of revenue was contributed and donated related to that in 22 that obviously wound down in 23. And then the Health and Hospitals program is another program that was related to COVID-19 and had a lot of contributions in 2022 that there was less of in 2023. As you'd expect to see, consistent with when the revenue and the contributions go down, there's less money to spend on those programs. So program expenses also decreased about $9 million to a balance of, or to a total of 10.9 million in 2023. And again, same thing, a lot of those COVID-related programs, the money had come in, the money had been spent in 22, and what was left was kind of being spent in 23, but pretty much just a large decrease in overall activity from 22 to 23. And as it's really something we've seen across a lot of not-for-profits and government agencies where all the COVID money coming in, whether it be from government sources or individual or foundation contributions, we saw a spike in all those contributions during 22, And then 23, kind of as those programs tailed off, we have seen less. So that's definitely something we've kind of seen industry-wide, a typical trend for an organization like yours. Salary and related expenses is something that helped make up that $9 million decrease. You can see salaries and related expenses decreased about 104,000 to only 1.3 million in 2023. And this is mainly due to some various vacancies at the organization during the year. You can see senior programs and policy manager and director of development were just two of the examples of some of the positions that had openings at different points during the year. And then lastly, down toward the bottom, as kind of mentioned before, that investment loss was about $420,000 during 23, due to the decrease in market value of that intermediate duration bond fund. So that's something I know we mentioned last year at the meeting. Something we wanted to bring up again this year was just how those investments, what's put in there, when that money is, if it's restricted money and it's used and then lost in the market, the only way to get it back is kind of back through the market again. I'm going to go back a
John,
slide.
I'm gonna actually jump in here for a second, if possible.
Sure.
Okay, so just talk a little bit more about that investment and the risks related to that. Right now, a substantial portion of your overall investments are, sorry, a substantial portion of your overall assets are that investment right there that's in this interim duration bond fund. And when you take something like a bond fund, instead of just going and buying bonds yourself, you actually kind of increase the interest rate risk, because as interest rates go up, the fund will rebalance itself for losses, so it will continue to buy. And so you'll see a little bit more in the dividends you're going to get out of the bonds, because the bonds it's buying pay at a higher rate, but all the bonds it's holding will be marked down because those are going to sell at a lower market value. So that type of interim duration bond fund is going to do poorly in an increasing interest rate economy. As we start to see interest rates level off, the performance gets a little bit better, which is why you see the loss be substantially less this year versus last year, because we are a little bit more level in interest rates year over year, but you're still seeing those losses. Still quite a bit of risk by holding the majority of your assets in a fund like that. They can experience substantial losses. And in the past 2 years, effectively $2 million of the losses have come from holding money in that fund. And that's what's really driven you into this deficit position for the unrestricted net assets. So I just wanted to point that out again. I know we talked some at the meeting last year, and it's not nearly as bad as it looked like last year, but you still have, as this slide here that John went back to shows, over $10 million in these investments. So there's still a lot of money to potentially lose through the over time with increasing interest rates in this type of fund. So I just want to be clear that that's not necessarily as safe an investment as just buying bonds on the market where you can hold maturity yourself. When you put them in the funds, because of the rebalancing, it does create some additional risk.
And do you have a recommendation? I don't know if you're allowed to give a recommendation, but do you have a recommendation about what percentage or general observation about what kind of percentage we would want to take out of intermediate and put in individually held bonds? Because it does seem like a pretty high risk exposure. And if you're saying we've lost $2 million, that's pretty painful to hear.
Right. So I would say I can't really give you very specific targets to follow or tell you what things to go into. What I can do is effectively point out where I'm seeing risk. I think almost anyone in the investment world will tell you diversification helps. And if you're looking at buying what are deemed to be low risk investments, which are usually like US government securities or municipal bonds and things like that, going and buying them directly is a lot safer than going and buying them in a fund, because you don't get that rebalancing. You can always hold them into maturity. So the worst thing you've lost is time value of money in that case. So that's
That make-
that's
that
something
makes
Bill,
that-
just
sense.
in response to your question, Bill, I just want to highlight that our recently reassembled Finance and Audit Committee, this is going to be one of the top issues to be explored at the committee level. We are going to be interviewing a prospective treasurer this month, and that will be the top priority for them once they're appointed as well.
Great. Thank you for that, Marcella, because that was my point is, can we review our investment process and our investment company if we have one? So thanks for that. We'll take that up offline.
Absolutely.
I'll let you go on, John. I don't know how much longer I'm going to have a stable connection. I've been in and out quite a bit, so thank you.
Okay. All right. So that was a recap of kind of the face financial statements. Now we'll go through, we got a couple charts here, a couple graphs that that show kind of a overall big picture standing of the organization related to the 23 statements and years in the past. So here's one financial indicator ratio that banks, a lot of different people in the finance world take a look at to see the health of an organization, and it's the current ratio. So it's simply the current assets divided by the current liabilities. It kind of shows how much current cash, receivables, investments, how much of those current assets are available to the organization versus the current liabilities, like the accounts payable and the short-term debt that may be coming due if the organization is going to be available or able to pay that. And you can see the number has been rising over the last 5 years. After a small dip in 2021, you can see at the end of 23, you're at a ratio of 9, which again is a really high number. Looks good compared to the normal benchmark of 1 to 1. I will say the reason pretty much for that is just the lack of debt that the mayor's fund has, right? Your only liabilities are really the outstanding invoices. There is no mortgage, there is no big debt items that would kind of help that number be closer to 1. So pretty much all the investments, receivables, and cash are just there to pay the program expenses and to pay for the mayor's fund's mission to carry out the activities it's designed to do and help the people it's designed to help. With that being said, program expenses is really the largest item on the statement of activities, and that's kind of in line with what the mayor's fund is here to do, right? Is to put out all those programs to help the public and carry out the missions that the donating foundations and the donating agencies are designing the mayor's fund to distribute that money for. So this is a number which shows program expenses versus overall expenses. You can see from 2019 to 2023, you've always been above 90%, which is pretty high above a typical benchmark number of 75% that sometimes not-for-profit organizations take a look at. So what it means is in 23, 94 cents on the dollar was spent on program-related activities, which again is a good thing. It shows that all the money coming in that's then being spent isn't being wasted or used on too much of like fundraising costs or too much on management in general. It really shows that when a foundation or somebody donates money into the mayor's fund, that money gets turned around and used on the program it was designed for. So you can see the slight downturn in trend from 2020 to 2023, but really it's just about 4%, and anything over 90 is going to show a lot of the money being spent on program expenses. Net position trend.
Can I just add a note
Sure.
on that? So this is something that has come up in our previous board conversations and was a great influence on the FY24 budget approval. which coincided with our approval of an increased administrative fee, increasing it to 12%, because while having this percentage above 90 shows that we are very lean and the vast majority of the resources go back out into programming. What we also recognize is that we do need to invest in our internal capacity to do this work well and efficiently and streamline it. So we're trying to right size the percentage of these dollars that are going towards the actual operating of the organization. So I expect that next year this will drop, but still be well above the 75% benchmark.
Sounds good. So next we'll move to net position trend. As we kind of talked about between 22 and 23, the losses that have kind of built up related to the investments. Here's a further out view of the past 5 years. You can see 2019 to 2020, probably as the market was doing really well, then we've started to have a little bit of a downturn from 2020 to 2023. And most of that is made up of the investment losses. And otherwise, the contributions and expenses have been staying pretty, while the gross amount may go up and down, the contributions and the expenses have stayed pretty even as you would expect. So if you're still following along with the statements, we went through a couple of the pages that were the face financials. And then from there, there's a lot more pages behind that are all different notes. And these notes, I'm not going to sit here and read them all out loud. But if anybody has any questions, they can jump in or they can reach out to us afterwards. All these notes pretty much show, you can see note 1 and 2, just describe the fund and describe the accounting policies. And then from there, a lot of the numbers and balances on the face of the financial statements are expanded on with more detail, whether it be more numbers or more explanation. Note 5 is a big one that provides the detail of the restricted net position. So that shows that net position number and all the different programs that have restricted money held in there and how much was spent in 23 and how much came into that program in 22. So that's a big one. And then note 8 discusses the employee retention credit revenue that was received in 2023.
Hey,
John,
Oh,
jumping again for a minute. There's a couple other things I just want to point out. The first one is just as a nomenclature thing to make sure everyone knows what we're talking about. Note 6 talks about contributed non-financial services. That is just the new name our profession has decided to give to the things that were traditionally called in-kind services. So anyone that's been around nonprofit accounting for a while might not recognize that terminology, but it's just a replacement of the words in-kind services. And then the other thing is talking about note 8 that John just mentioned about the employee retention credit and going along with the contingency note that there is in note 9. I just wanted to mention generally the employee retention credit program is something where we have a contingency note because that program is going to see a lot of audits at the federal level. And so you may at some point be audited. There could potentially be a recoupment from an audit. So we do have a note that just emphasizes that point. And that's something that will stay there for so long as that money is still potentially at risk from a statute of limitations time frame, which I think is a 5-year time frame from filing, or the IRS actually comes in and does an audit and blesses it or recoups it. So that's just why that contingency is there. As a program, it is something where we are expecting to see a lot of recruitment in general because the IRS has actually gone and stopped the program at a little bit earlier right now because of the number of issues they're seeing with it and number of things that they think they're going to have to recoup from. So there is some risk related to that I just wanted to address. John, you can.
All right, so that kind of wraps up the financial statements and the opinion on those. With that, we're also engaged with being a government entity to provide a GAGUS opinion, or an opinion on related to the generally accepted government auditing standards report. So there's an independent auditor's report on internal control over financial reporting and other matters based on the financial statements in accordance with government auditing standards. So in this report, we just took a look at the controls in place over the organization. And like we had last year, again, there is a material weakness in internal controls. And that mainly came about due to from the start of field work to the end, after back and forth with audit adjustments and getting down to the correct reasonable numbers. There was about $4 million worth of adjustments from the way the books were first received to the ending numbers we're presenting here today. About 1.5 million in program expenses were added on. About 1.87 million in contribution revenue had to be accrued and adjusted for. And so that's pretty much why the material weakness and internal control finding is still there and carried forward from last year. That finding does have some criteria and some suggestions for how to kind of try and correct that and improve on those control processes going forward. It just talks about just having the finance and management team having a sound understanding of the gap and accrual principles, and just try and keep up on as expenses and revenue and receipts come in, just making sure those are recorded in the proper fund code and up-to-date numbers at all times. Along with that, this year there is a management letter. So this management letter is just an additional piece of correspondence that we felt the need to provide. This management letter is a confidential item, so it's just something between management and the board that we just wanted to provide in writing, showing another area of possible improvement going forward, just to discuss the allocation and tracking of expenses related to a lot of those restricted contributions and federal grants. It kind of goes hand in hand with the internal controls and just making sure that every dollar that's spent is allocated correctly, and if is used for a restricted program, that it's recorded that way so that unrestricted net position doesn't take any unnecessary hits. So with that, to wrap up, we will obtain a management representation letter. So that's something that will help us issue final. When we're done with this, when the board approves the financial statements, I'll email a letter over to Marcella, and it just is pretty much 2 pages worth of representations, just saying that management and the finance team provided everything we asked for and gave us all the documentation we requested throughout the audit. And then with that, the tax forms will be issued in draft form at some point after that. They'll be provided to management for review, and then the 990 and the Char 500 can be filed. And there was a change in filing requirements for that Char 500 last year. I don't know who did it for you, Marcella, but it does have to be done fully online. So it should be the same process that was done last year, but we just wanted to reiterate that it has changed from years past, and it's fully online.
John, I have a question regarding the recommendation that that management evaluate outstanding receivables and payables on a periodic basis. Are you able to be a little more specific? Like, what's the best standard? Like, are we talking about monthly? Are we talking about quarterly?
Really, whatever can just help keep the numbers the most up to date. So whether that has to be done monthly or quarterly, it kind of depends. I can't really give a good suggestion there, but just from the fact that when we got the audit and the trial balance we were given in the beginning, if we didn't end up auditing those numbers and taking a look at them, they just wouldn't have been accurate. That's kind of where that comes from. Because you'd like to quarterly, monthly, whenever you have board meetings or reports, or when somebody wants to look in, ideally those numbers would be pretty accurate, right? So you can get a taste and a feel of exactly what's going on at that point in time.
Right, getting a clear snapshot.
Yeah.
Yeah, thank you. That was very helpful. And also the explanation of some of the other internal control issues that we need to address. Thank you. That's informative moving forward.
No problem. So the other final piece of representation that we provide as part of the engagement is a report to the board. So along with this presentation, there's like a 2-page letter toward the back of the statements that kind of discusses some overreaching things, like how there were no new accounting policies adopted during fiscal year 23, all of the estimates. So things like determining how much to have on an allowance or bad debt related receivables were reasonable and supported. And then we had no difficulties in performing our audit or disagreements with management over any accounting, reporting, or auditing matter. So with that being said, I worked back and forth with Jill for a lot while she was there, and then toward the end with Peter, and a little bit with Kamaria towards the end. And everything that we did propose or adjust or discussed, they totally took in and moved forward with, and definitely listened to and posted all those adjustments. So it's not like we had any disagreements or anything like that.
And John, I just want to say, even though obviously everything is not all the way to where you'd want to have it be, we'd like to not have these adjustments and have accurate numbers throughout the year. I think you probably agree that as you went through this, the detail was provided to us in a more efficient manner, that the corrections we were finding, we worked with the management team on, they largely were able to help us get to the new correct numbers. We weren't just having to go back and do everything ourselves. And I think we did see some significant improvement from last year in spite of seeing significant turnover. Would you agree with all that, John, as well?
Yes, definitely. Yep. I believe we're here almost like a couple weeks earlier than last year.
I think actually a few months earlier. Last year, I don't think the meeting was actually until January. This year, you're going to be able to be timely to the city. And so there's a definite improvement that's happened at this time. You basically turned over your entire management team since last year. So still seeing that improvement and that in the face of all that turnover and everything is a good thing. Obviously you have steps left to take, but we are seeing things going in the right direction from that perspective.
Yeah, I 100% agree. So then, yeah, that we kind of touched on that, right? The last bullet, all adjustments were posted and agreed upon. That really, there was no back and forth. Anything we were like, hey, we think maybe this is going to have to be adjusted. Can you provide us the support? Peter was pretty much able to do that, gave it to us, and then posted the adjustment timely. So that wraps up the presentation. If anybody has any questions, they can definitely ask them right now. If not, they can email either myself or Brent, give us a call, and we'd be happy to answer them.
I have a question, and it goes back to the investment. Was there, and it's more for informing us for the future than anything else. Had you had this discussion previously, not with this new administration, we know that this is too new. We've lost $2 million because we've been in this fund, but there's been a loss of $10 million over 3 years, which is quite considerable. It's more than what we raised. Had there been a discussion about ways to mitigate that distribution bond fund? And if so, had it appeared in other audits? I want just for clarity's sake and for history's sake.
So in terms of the historical context of this, I can tell you that last year was our first year as auditor. Previous to that, it was RSM. Last year in the board meeting, we did have this discussion about the investments, talking about why there was $1.6 million loss last year, with some recommendation that you take steps to try and get a committee together to look at what the best investment policies would be going forward and the best investments to be in. So that was something we raised in the first year that we were your auditor. Previous to that, I can't speak to what they specifically talked about in the meetings. I can tell you that RSM did, at minimum, disclose the interest rate risk in the financial statement. I cannot begin to say if they emphasize that point to the level that we have, but they definitely did at minimum disclose that it was a real risk that existed in your financial statements.
Okay, great. Thank you so much for that.
We have time for any additional questions. If there are no questions, I'm going to ask if there's a motion to approve the FY23 audited financial statement.
So moved.
Second.
Thank you. All in favor?
Aye.
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 That is the full committee, so that motion carries. So I will now ask for a motion to close this meeting of the Finance and Audit Committee. May I have a motion to close the meeting?
Before we close it, can we have
Sure.
Can we just have a time frame by when we will meet again to discuss this investment issue? All right, I think
Sure.
I don't want us to bleed any more money. So I would like to do that, even if we call an ad hoc or whatever you call those emergency meetings between our regular meetings.
And I think related to that, if I might, Lorraine, I think that, does that conversation need to wait until we have a new treasurer on board?
I think it should.
Okay.
But just in terms of the timeline of what's coming up next, we have a full board meeting scheduled for 10/17. So that'll be our next time together. Between now and the next couple of weeks, I'll be out until the 16th. But in the meantime, we'll be scheduling a meeting with myself, our Director of Finance, our board chair, and a candidate for treasurer. So hopefully we will have identified someone this month, and then we can schedule a first meeting of the audit and the Finance and Audit Committee with the new appointed treasurer. And that should be able to happen before, I think, the end of November.
Great. Good.
Any other questions, not about the audited statements, but before we close the committee meeting? Okay, I'll ask for a motion to close the committee meeting.
So moved.
Second.
You have a second? All in favor?
Aye.
Motion carries and the meeting is adjourned.
Thank you all.